Welcome back to the deep dive. Today we're tackling a really fascinating company, one facing, well, a pretty critical moment. UiPath, ticker PATH. This isn't just about software updates, folks. It's about a huge strategic bet. The core question we're digging into for you is this: can UiPath, the king of traditional robotic process automation, actually transform itself? Can it become that essential conductor for the AI-driven future, or is it maybe becoming a bit of a relic, overshadowed by the big tech players?
That's the tension, absolutely. And it's right there in the share price volatility. We've gone through all the research you sent over, and honestly, the conclusion jumps up pretty clearly. That current price, $13.85 as of September 30th, 2025. It's sitting almost smack dab in the middle of our estimated intrinsic value range. So today we'll break down exactly why the market seems to be balancing that massive potential opportunity against, frankly, some very significant risks tied to this big pivot they're making.
Right. So our mission today is that full deep dive on UiPath using that $13.85 price as our anchor. We're going to look closely at the new strategy, their financials, which are surprisingly solid in some ways, and of course, the competitive threats. It's a critical time for them. ### part 1, business, management, and financial foundations.
Okay, let's start with the basics. How do they actually make money?
Chapter 1, business understanding. Well, fundamentally, UiPath operates on a software as a service model, a SaaS model, and that gives them that really attractive, stable, recurring revenue stream. But what's maybe more interesting right now is the shift happening within that revenue. Licenses, they used to be the bulk of it, maybe 55%, but that's actually decreasing. Meanwhile, services revenue, think long-term consulting, integration help, training, that's growing. It's now up to about 45% of their total revenue. That 45% in services. That definitely points to that land and expand play, doesn't it? Moving beyond just selling a license up front to building like a deeper ongoing relationship. Okay, let's quickly break down the core platform itself. We know studios where you build the automations, right? Low code, drag and drop. And the robots are the things that actually, do the tasks, attended or unattended. But the third piece, the orchestrator. For listeners maybe not deep in RPA day to day, why is that potentially their most valuable bit of tech?
Good question. Because the orchestrator is essentially the brain of the whole operation. It's the central command center. It handles deploying the bots, managing them, securing them, monitoring them. Imagine a big company with hundreds, maybe thousands of these bots running everywhere. Orchestrator is what makes that manageable, scalable, and governable. Without it, you just have, well, a chaotic mess of individual bots.
Got it. Okay. And that leads us right into this crucial strategic shift they're making. They seem to realize that old school rules-based RPA is getting, well, commoditized fast. So they're pivoting hard into something they call agentic automation. What exactly is that?
Correct. Agentic automation is their move beyond simple RPA. They're combining that traditional rules stuff with more advanced AI, machine learning, even large language models, LLMs. The goal isn't just automating a task anymore. It's about enabling intelligent orchestration of complex processes. They're rolling out new tools like Agent Builder and Maestro specifically for this to build and manage these more cognitive workflows. It's a move from automating a task to orchestrating an intelligent outcome.
And they certainly have the scale to try and pull this off. The numbers are pretty big. What was it? $1.723 billion in annualized recurring revenue, ARR. Growing 11% year over year, over 10,800 customers total. But the stat that really screams moat or stickiness to me, it's got to be the dollar-based net retention rate, DBNRR. It's 108%, which is phenomenal, really. It means that, on average, their existing customers spend 8% more with them the following year.
Right.
That signals high switching costs and successful upselling. It tells you those 320 big customers, the ones spending over $1 million a year in ARR, they are deeply embedded with UiPath. It's hard for them to just rip it out.
Okay, but we have to be realistic about the competition. Let's talk about the 800-pound gorilla, Microsoft Power Automate.
Yeah.
Microsoft bundling that in with Office 365, with Azure. I mean, isn't that an existential threat? Couldn't it just crush the low-end RPA market?
Right.
That's the multi-billion-dollar question, isn't it? It's a massive threat. How do you compete when Microsoft can just give it away, essentially? UiPath's countermove is actually quite clever, strategically. They're positioning themselves as the neutral Switzerland of automation. The idea is to be the best-of-breed orchestration layer that integrates with everyone, all the major AI players, even those running on Microsoft's own platforms. They're not trying to beat Microsoft head-to-head on the basic bot stuff anymore. And they do have strengths to build on, that dominant 35.8% RPA market share and those consistently high gross margins, around 83%. That's elite territory.
Yeah, that 83% gross margin is seriously impressive for software. And you mentioned the network effects, too, from their marketplace and the certified developers in their academy. That definitely helps build that moat. Okay, let's shift gears to the leadership. Who's driving this pivot?
Chapter 2, Management Evaluation. Well, execution is everything in a pivot like this. And UiPath is an interesting setup. You've got the founder, Daniel Dines, back in the CEO seat since 2024. He's the visionary, the product guy. And he came back with a real sense of urgency, basically saying the company's survival hinges on AI success. So laser focus there.
And balancing him out is Ashim Gupta, the COO and CFO. He's got that GE background, bringing operational discipline, financial rigor. He's focused on getting to positive free cash flow. And their spending reflects that, right? Big R&D investment, what was it, $380 million last fiscal year?
Exactly. $380.7 million in R&D in FY24. It's a huge bet on building out this AI-driven future. But their M&A, their acquisitions, are also really strategic. Look at the Peak AI deal back in March 2025. That wasn't just buying tech for tech's sake. Peak AI brings these vertically specialized AI agents, so UiPath can move from selling just a generic platform, selling specific solutions, like, say, an AI agent pre-built for optimizing retail inventory. That drastically cuts down the customer's time to value.
That makes sense, moving to solutions. But I guess the question is one acquisition like Peak AI enough? Is it fast enough? I mean, compared to the resources Microsoft can throw at this, can they really pivot into all these vertical solutions quickly enough to matter?
That's precisely the execution risk the market is wrestling with. Speed is absolutely critical here. On the financial maturity side, though, they are signaling confidence. They authorized a big $500 million share repurchase program, and they've been active, buying back 8.3 million shares already at about $12.10 average price. No dividend, though, still focused on growth and buybacks.
Right. And we should probably touch on the return on invested capital, the ROIC. It's negative 4.6%. How should we interpret that?
Yeah, you have to see it in context. For years, UiPath was all about growth, grabbing market share, heavy R&D. Profit wasn't the priority. So a negative ROIC isn't surprising for that phase. What's important now is that clear trajectory towards profitability that we're starting to see.
Okay, let's talk more about that profitability journey.
Chapter 3, Financial Analysis. So there was definitely a period of concern. Revenue growth had slowed down, hitting just 9.3% in fiscal year 2025. That worried people. But the recent signs are much more encouraging. Looks like they might have hit an inflection point. The latest quarter, Q2 of fiscal 26, saw growth re-accelerate back up to 14% year over year. And importantly, management raised their full-year guidance. That suggests these big AI bets, the new strategy, might actually be starting to gain traction in the market.
And the underlying economics, as you mentioned, are pretty elite. That gross margin consistently around 83%, that's huge leverage potential. But the really big news is on the bottom line, right? After years of GAAP losses.
Exactly. The operational leverage is finally kicking in. Their trailing 12-month TTM GAAP net margin just turned positive. It's 1.35%. Now, that's still small, obviously, but crossing that GAAP profitability line is a major milestone. It shows the business model can be self-sustaining.
And underpinning that is the cash flow, which sounds really strong.
It is. Very strong. They generated $309.6 million in TTM free cash flow. That's real cash hitting the bank account. That robust FCF proves the underlying business economics are healthy, even before you see large GAAP profits, perhaps. It's the engine.
And that cash generation fuels what you called the fortress balance sheet.
Precisely. They have virtually no debt. The debt-to-equity ratio is tiny, 0.05, and their current ratio, a measure of short-term liquidity, is a very strong 2.75. They have plenty of resources to weather storms or keep investing.
So financially strong, how does that translate to valuation? The PE ratio looks kind of crazy high.
Yeah, ignore the PE. It's over 300 right now because that recent GAAP profit is still tiny, so it distorts the ratio. For a company like this, still largely valued on its growth potential and sticky sauce revenue, the price-to-sales ratio, PS, is much more relevant. It's currently sitting around 4.9, which, for a high-margin sauce leader is arguably defensible. But it absolutely demands they keep delivering on that growth story.
#TAG part 2. Market, risk, and conclusion. Okay, let's shift to how Wall Street is viewing UiPath right now.
Chapter 4, Market Sentiment. Well, leading up to the end of September 2025, the analyst consensus was pretty cautious, overwhelmingly a hold rating. The average 12-month price target was around $13.30, pretty close to where it was trading before the recent news. Basically, everyone was kind of waiting for proof the AI strategy was working.
And then, boom, September 30th. The stock jumps, over 14% in a day? What happened?
Massive news. Blockbuster strategic partnerships announced with basically the entire AI A-list. NVIDIA, OpenAI, Google, and Snowflake.
Wow. Okay, that's not just one partnership. That's like getting endorsed by the whole ecosystem at once.
Exactly. It was seen as a huge validation of UiPath's Switzerland strategy we talked about. It signals that these major AI players see UiPath as a necessary neutral layer to actually connect their different models and make them usable in complex enterprise workflows. It's a massive credibility boost.
And this surge happened despite pretty significant bearish sentiment, right? The short interest was quite high.
Very high. Between 12.55% and 12.95% of the shares available for trading were sold short. That's a lot of people betting against the stock, which of course creates the potential for a short squeeze. If the price keeps rising on good news, those short sellers have to buy back shares to cover their positions, pushing the price up even faster. And with 4.5 to 5 days needed to cover those shorts based on average volume, a squeeze could be quite dramatic.
Interesting. And the technical charts were aligning with this bullish turn, too.
Yeah, the technical picture turned positive. The stock price moved decisively above both its 50-day and 200-day simple moving averages. That's often seen as a strong technical buy signal, sometimes called a golden cross, suggesting a potential shift to a longer-term bullish uptrend.
Okay, let's briefly look inside the company. Who actually owns the shares?
Chapter 5. Ownership structure. It's heavily owned by institutions, somewhere between 60% and 82%, depending on the source. You see the big names, Vanguard, BlackRock, UBS. That lends a lot of credibility. And interestingly, the recent trend shows a net positive flow of institutional money into the stock. So the big players seem to be buying on balance.
And insiders still hold a significant stake. Alignment seems good there.
Very good alignment. Insiders own about 21% overall, dominated by founder Daniel Dines, who holds around 20% himself. That's significant skin in the game. And we should clarify for you listening, you might see headlines about insider sales. These appear to be standard pre-scheduled Rule 10b5-1 plans. That means they were set up in advance for diversification or tax purposes, not necessarily a sign that insiders are suddenly bearish in the company's prospects. It's routine for executives.
Right. Important context. Any flags on ownership structure?
Just one thing to note is the concentration. The top 11 stakeholders control roughly half the company, about 50%. The upside is that allows for potentially very agile, quick decision-making, which is vital in AI. The downside is the company's fate is very much tied to the vision of that small group.
Makes sense. Okay, let's pull it all together now with a look at the overall risks and opportunities.
Chapter 6, Risk Assessment.
Yeah.
All right, let's use the SWOT framework. The strengths are clear. Dominant market leadership in RPA, that fortress balance sheet with tons of cash and no debt, those fantastic high gross margins, and the stickiness, the high switching costs creating a moat.
Okay, and the weaknesses?
The weaknesses are still there. That history of gap losses, even though they just turned positive TTM, the recent growth deceleration before this latest quarter's pickup, and the platform itself can be complex, leading to those long sales cycles, like 6 to 9 months typically for big enterprise deals.
Right, but the potential payoff, the opportunities are huge if they get it right.
Massive. The total addressable market, the TAM, for intelligent automation is enormous and growing fast. Forecasts range from, 17% up to nearly 44% compound annual growth rate, CAGR. Capturing a slice of that depends entirely on successfully executing this agentic AI pivot and really delivering value with those vertical-specific solutions, like the peak AI stuff.
And the flip side, the threats. It comes back to competition, doesn't it?
Overwhelmingly, yes. The biggest external threat is that intense competition, primarily from Microsoft and its distribution muscle. And just the sheer speed of change in AI, they have to keep innovating relentlessly or risk getting leapfrogged. We should also quickly mention macro factors. Higher interest rates aren't great. They can slow down customer spending. But inflation actually works as a bit of a tailwind for UiPath, because as labor costs rise, the demand for automation to save on those costs tends to increase.
Okay, a complex picture. Let's try and synthesize this into a conclusion.
Chapter 7. Conclusion. All right, the bull case. What's the argument for UiPath right now? It really centers on that recent validation from the NVIDIA, OpenAI, Google, Snowflake partnerships. That signals they have a real shot at being the central AI orchestrator. Combine that with their huge cash pile, their strong free cash flow generation, that sticky platform moat, and a focused founder CEO who seems determined to win in AI. That's the bull narrative.
Okay, makes sense. Now, the bear case. Why might someone be pessimistic?
The bear case is straightforward. Can they actually withstand the competitive onslaught from Microsoft? That's threat number one. Number two is execution risk. This pivot to agentic AI is ambitious and it's happening incredibly fast. Can they actually pull it off effectively? And third, they still need to prove they can deliver not just occasional gap profitability, but sustained, long-term, high-growth profits. The market needs to see that leverage consistently flow to the bottom line.
So, Bring it back to valuation. You mentioned the DCF model earlier.
All right. Our educational discounted cash flow model, just for context, spits out an intrinsic value range of roughly $12 to $16 per share. Now, critically, that model assumes they can achieve about 15% revenue growth initially,
Right.
tapering down over many years to a terminal rate of 3%. And we used a discount rate, a WACC, of 10.0% to reflect the risks. Those assumptions are key.
So, with the stock price at $13.85, what's the final verdict?
The final take is that the current share price of $13.85 seems, well, fairly valued. It sits almost exactly in the middle of that $12 to $16 estimated intrinsic value range. It feels like the market is accurately pricing in both the massive potential upside if they become the core conductor of the automated enterprise, and the very real risk that they could stumble in execution or get squeezed by competition. The next few years, driven by this AI pivot, are absolutely critical. It will determine which way the scale tips.
So, here's a final thought for you, our listeners, to chew on. If UiPath does nail this Switzerland strategy, if they successfully integrate all the major AI models and become that essential orchestration layer, have they effectively created a whole new, maybe unassailable category? One that sidesteps the raw power of the cloud giants? Or is Microsoft's built-in distribution advantage just too high a mountain to climb in the long run? Something to mull over.
Thank you for tuning in for this deep dive on UiPath.
Yes, thanks everyone. And hey, we really count on your input for what companies to cover next, so please like this video and subscribe to the Stock Analytics AI YouTube channel. Remember, our members, it's just €4.99 a month, get priority on deep dives for the tickers they suggest in the comments. We're covering all the S&P 500 stocks over the next few months, and members get that exclusive priority access. Or, if you just want a one-off analysis, dropping us a super thanks is a great way to get a specific company onto our list.
And finally, the necessary disclaimer. This deep dive was generated by an AI system purely for educational and informational purposes. It should absolutely not be taken as financial advice. Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.